Hi, good afternoon, everyone. Welcome to today's Sifted Talks. I'm really excited for this one because we're talking about a sort of stage of the startup life cycle that I've not particularly focused on recently. I've been really focusing on the growth stage, companies who, having these big, well-publicized struggles, but we're taking a step back and really going earlier in the startup life stage with Series A, what it takes to fundraise right now, if any fundraising is even possible, and how Series A startups can best prepare to try and secure funding from investors. Today, joining me, I've got three excellent guests from different parts of the startup ecosystem. So Martin Sokk, CEO of Lightyear, and Christina, who is an angel investor. And then we've got Louis from Point Nine Capital, the VC firm. So really looking forward to hearing their perspectives on this topic. We've got this Q&A box that you can probably see. And just if you have any questions throughout the talk, just put them in there. You can upvote ones that you see other people contribute, and we'll just be sort of taking those throughout the conversation when the time is right. But really keen to answer your questions and be as useful as possible with this talk. So yeah, I thought we'd just dive straight in really and talk a little bit about what we're seeing as a whole across the startup ecosystem and how Series A differs from other stages. Louis, I wanted to start off by asking you, I've been seeing these huge funding drops at late stage, especially on my beat, fintech. But I understand that this has sort of started like a bit of a ladder effect, and it's creeping back earlier and earlier in terms of the funding drought. I've seen this a bit at Series B. Has the hyper pessimism sort of reached Series A startups yet?
Yeah, happy to take that, and thanks for having me. I think the conversation will be interesting also because none of us is really a Series A investor. So to that extent, we're actually, just observing the ecosystem and are not necessarily biased. Like what we do at Valuation is, from like pre-seed to early Series A's, but most of what we do is prepping our portfolio companies to raise large Series A's. So what I see, and maybe to give more context, and I think it's an experiment, but let's try it. I will just try to share my screen for people to understand exactly what's happening. So in the big scheme of things, what's happening is like, and this is a blog post that was published by Tom Tungus, who's a great venture capitalist in the US, is that the venture capital market as a whole is correlated with where the NASDAQ is. And the correlation is actually very high, like 0.98. And what happened, as most of you know, is that, the NASDAQ crashed quite a bit. So chart number 2, I just looked like this is just the Bessemer Cloud Index. So Point Nine, we invest a lot in like software and B2B software. So this is the Bessemer index is basically an index of SaaS companies. And this is exactly what has happened since 2021. Like the market has crashed quite a bit by like, let's say close to 70%. The good news is that we see some level of recovery happening now. That you see here in green, you see the NASDAQ, and in blue, you see the SaaS companies specifically. And now I just pulled up some stats from Carter, and then I'll give you a more qualitative answer based on what I see at Point Nine, but exactly the correlation that Tom Tungus was seeing and already back in 2008 is also happening here. So in case you see my screen in big enough, what you see is like, okay, the market went in when it comes to seed and Series A funding. This is funding as a whole. Then we look at seed and Series A, like went up quite a bit, correlated with the level of the NASDAQ, and then it crashed quite a bit, which is also what we see. If you look at, seed and Series A, specifically, you have the data here. And, Carta is a cap table management software. So they actually log the rounds. So it's very usually good data. A lot of it is US based, but I think there is a very high correlation between the US and Europe, maybe with a bit of a time lag. And what you see here is like, there is somewhat of a reverse to like what was happening in 2018, meaning in 2018, you had roughly 400 Series A per quarter, leading to 4 billion invested in Series A. When the market was at the peak, you had roughly 800 Series A for 13 billion invested. So roughly like a Series A before used to be a 10 million round, and you had 400 of them. It went to like closer to a 15 million round, and you had double the amount. And now we're going back to the level that we had in 2018, meaning rounds look closer to 10 million, and you have roughly 300 to 400 per quarter. That's the quantitative answer to your question. I guess the more qualitative one, based on what we see, is like if I look back a year ago, in our portfolio specifically, we were seeing a lot of Series A. We probably were seeing 5 to 10 in the first 6 months of the year. We probably saw only two or three in the last 6 months, which kind of corresponds to what you see in the market as a whole. And we can discuss that later, but the main factors are the fact that people don't know that it's maybe not a great idea to raise now because the bar has become higher and maybe there is some level of over pessimism, as we say, so they try to stretch runway and be even more ready to go out when they need to go out.
Yeah, that brings me, it was super interesting to see the stats first off, actually. And yeah, you're right. I think there's always a bit of a data lag as well with funding rounds. That's what we find when we try and do these data takes. So it'll be interesting to see sort of by the end of Q3, we'll have a really good idea of whether it's really hitting Series A. Martin, I wanted to ask you, seeing as you've been through it all in a bit of a different environment, when you're speaking to founder friends and getting feedback from investors, if people are out trying to raise at the moment, what does that look like in practice? How has that changed, especially at the Series A stage? Is there much more of a focus on financials? Obviously the well-trodden, the favorite phrase right now, the path to profitability plan. Like how has that changed for the founders?
Yeah, so we're building investment platform and we raised our Series A roughly a year and a half ago. So that was, I would say, hyper optimism in many ways at that time. And I think like a hyper pessimism is actually a pretty good word here. Like it kind of feels like a pendulum. Like everybody was like thinking that everything can only go up. You can always acquire customers and grow out of their problems. I think now the pendulum is another angle and everybody is effectively less optimistic that the growth will happen. So I would say that the world kind of fundamental problems haven't changed. So the problems are still there, like especially when we're talking about Europe, then the general financial product landscape in Europe is really weak. So there's like a lot of things what needs to happen and to be fixed. But like the question is that, are you able to finance that? So, but I think in a good way to think about it is also that it's like if you're building a financial company, then you need to figure out how do you make money. So I think like getting away from this kind of weird angle that like don't care about revenue, don't care about unit economics, we just grow and then we'll figure out later on. I think it's actually pretty foolish in a way. Like today, it's yes, a little bit more pessimistic. People are like more like earlier and earlier stages, like show me all the unique economics and how do you scale out of this. And like maybe answers what like not many companies have today. So they need to figure it out and make up numbers in a way. But in the same time, it forces companies to build actual financial companies. And like in that sense, I would say that it's actually maybe a win-win market right now. So companies get stronger, significantly stronger. All the companies who survive this will get a really good kind of product out there. And like when the market sentiment comes back, you're able to scale quite a bit. And also in the same time, coming from investing angle, like investors should invest when the blood is on the market because everything's cheap. So today is an amazing time to invest in companies, even if sometimes maybe the founders are getting a little bit less, but like it's a good combo. Like you get like really good price in and you're able to go in. So going back to like what is the raise right now? So if year and a half ago, a lot of people just got funding because they had future projections. Today you need to come in. And so I think Series A, at least you need to show that something what was more true in Series B is that if you now start scaling, then you're not going to die. So it means that you have to be gross profit positive, means that you're able to, you have the kind of levers to pull that you're starting making money if you're big. Maybe like a year and a half ago, that wasn't so true anymore. So it's more optimism that you will figure it out. So it's an interesting position to be. I would say that I'm actually pretty optimistic on the market right now, even if it's kind of weird time to be.
Encouraging answer, definitely. And one that sort of chimes with what investors were telling me sort of at the beginning of this period as well. Really quickly, somebody's asked in the Q&A box when we're going to be taking questions. We will take them when it feels right throughout the whole conversation. So put them in there. I can see them. We'll get to them. Christina, I wanted to now ask about the slightly trickier facet, which is Series A companies that had promised investors, that they'd reach these financial milestones or whatever by now in order to be able to tap them for more cash, and they haven't met those milestones for a variety of reasons. What is happening in those scenarios right now? Are they able to tap investors for more cash at this stage, or is it a question of investors saying, no, thank you, that is too risky, and we want to see these financials materialize?
Yeah, well, so I invest similar to point 9, sort of pre-seed and seed, and then up to early A. And I'm seeing now a lot of companies that are entering that phase where they had expected to do a Series A round either now or in the past couple of months. And I think, one of the things I wanted to mention is it's come up a little bit in Louis and Martin's comments, but Series A, there's a certain amount of opacity, I think, in terms of the definition of Series A, and it's shifted a bit over time. So sometimes it has to do with the amount that you raise. Sometimes it has to do with the sort of metrics for your industry and what levels you're at. And then that changes depending on the environment. So now there's a lot more emphasis on the unit economics and profitability for Series A, whereas before, as Louis said, it was more focused on the Series B level. So I think that that's one thing to sort of just take as context, that the goalpost has sort of shifted a little bit. So, that's something that I think investors take into account somewhat, that the environment has changed. And that's not only from a funding perspective, but also from a sector perspective. Some of these industries are, having a lot more headwinds linked to the macroeconomic trends that we've been seeing. But with that context, I think there's definitely more pressure on investors that have done a seed stage investment, especially. Because there's this shift in timeline, and a lot of startups are needing a little bit of extra 6 or 9 months. You're seeing a lot of bridge rounds. And so with this, without the milestones necessarily to fall back upon and sort of prove their path towards product market fit, you are seeing a lot more of a focus on, who are the investors that really align and have conviction in the vision of the founder. And who really trusts that either this founder can execute, and these are just sort of, circumstantial factors that are going to shift over time, and they just need a little bit more capital to really execute. So I think it's just another emphasis on why it's so important to make sure that when you do your pre-seed and your seed rounds, you really get you do your diligence, and you find investors that have a very, aligned long-term view of your sector, of the product that you're building, that they have a lot of confidence and conviction in it and the need for it in the market. And most investors don't want you to fail. So I think that there is, especially in sort of the first bridge loan, maybe even the second bridge loan, willingness to be able to sort of float you until you are able to reach those Series A milestones. So I think I'm seeing that there definitely is this pressure, and sometimes I say yes, and other times I say no. But I think what everybody has seen is that investors are typically carving out a bigger amount of their investment capital to sort of reserve for follow-on investments for startups. So, it's just take that would be my main takeaway, is to make sure that you're bringing investors on board that have a really, long-term approach to investments and really share your vision for the industry. And hopefully it'll work out in terms of those bridge loans.
Really, really useful. And I think that sort of answers, I saw a question from Wesley Baker, who was asking sort of how you avoid that black hole right now between business angels and Series A. I guess one other thing I want to ask there is that, does this mean that there's sort of a disproportionate amount of pressure on business angels to be filling that gap at the moment?
I do feel, I'll just take that really quickly. I think pre-Series A, there is a lot of pressure because angels typically have a lot faster cycle for investment decision making. We also typically like to bring other angels on board that have the expertise and the industry conviction that we share. And there's a lot more and more of these angel networks as well, that even if you're only investing, under 10K, if you get 20 angels, that can be a nice bridge round. So I'm seeing feeling a lot more pressure to tap my own network of angels around the globe to sort of invest alongside or do follow-on offerings. So yeah, that's definitely a trend.
Yeah, the only thing I would add to this is like, it does put pressure. I don't know if pressure is the right term, but some of the responsibility is on the shoulder of the existing investors. So depending on the stage at which you are, you need to make a conscious decision as to whether or not you believe the company has a good chance to get to the next stage or not, and have this discussion with the founder. And I think it's a good discussion to have, and it's an important discussion to have. And if we go back to your points, Christina, which were great, it's like you raise the seed when you have early signals of product market fit, you raise a Series A when you have product market fit, and you raise a Series B where you have some level of predictability when it comes to growth. When the market was at peak, everything was kind of shifted left. And to that extent, you didn't necessarily need to have these conversations in order to raise more money. Now that the market has shifted right, you need to get more growth. Then we need to assess together, like, how far are we from really reaching the milestones that are necessary in order to raise that next round of funding. But it's also true for the Series A investors ahead of the Series B, and for the Series B investors ahead of the Series C. So it's just kind of a movement in the market that everybody needs to follow.
That's just make one more quick point, Amy. I think on the Series A, also thinking of who are the investors that you want on board for Series A, already having that dialogue 6 to 9 months before you go for a fundraise. What are the milestones that they're looking for? So just make sure that you get that clarity. And if that shifts, then you're thinking alongside with the investor and you know what to expect basically when you're going to the market to fundraise.
Super useful. So that's the sort of constant dialogue about what everyone, because it's fair for everyone's expectations to be changing right now with the amount of uncertainty. We all know that investors don't like uncertainty, right? But I think so. Yeah,
strongly with that. You like uncertainty. Our job is to take risks and to assess these risks. There is no investment without uncertainty and risks.
But okay, yeah, I've been having quite a few conversations about sort of how far we can take that with what we're seeing with interest rates as well, though. But I'm just scanning through all the questions in Q&A because a lot of them are about appreciate we've sort of covered this a bit with what we've just said, but maybe going a little bit deeper, Louis. Like Tom is asking, are you seeing things like GMV, growth rate, take rate? Like, are these things that you're having to speak to your portfolio companies to really like have a good set on board already at seed stage in order to get to Series A in a way that you talking about things shifting left?
Yes.
What are the other metrics that you're having to? Because I think there's probably quite a few founders on this call who could benefit from that.
Yeah, sure. So like every year we publish a marketplace funding napkin and a SaaS funding napkin, which is kind of a condensed way for founders to understand what should be these milestones. And you see this shift left and this shift right going napkins after napkins. Probably don't have time now, but like happy to have a look at it in another session. I think it's all the more Tom's question is all the more interesting that is probably running a marketplace. So nice to meet you, Tom. And marketplaces are even more complex to run in this environment because you have this constant trade-off to make in between building GMV and growing revenues. And sometimes you can decide, you know what, I'm going to take this order that are not necessarily super profitable, or I'm going to spend more on marketing because I'm building power in the marketplace by building GMV. But in an environment that's maybe a bit colder, investors might say, cool, but this GMV is actually not a profitable GMV, and I'm not exactly sure that you will manage to monetize it. And what we see actually a lot is that a lot of the build-up of the GMV that happened during the kind of crazy years of 2020, 2021 is actually unprofitable, so that at the time at which you stop doing marketing, this GMV disappears. So some of the investors today looking at this are actually right, because we have a precedent that it was actually not right to spend on marketing. And to that extent, the only way to de-risk that or to face that uncertainty is not to look at GMV, but to look at net revenues, because net revenues is actually, you know, comparable to software revenues. And to that extent, the safer bet that you can have today as a marketplace founder is to say, you know what, I'm going to focus on profitability, as Martin said earlier on, and build net revenues rather than build GMV, because I'm going to have zero question whatsoever as to my ability to make money. But you might also do that at the expense of growing faster, the power that you have in the market on the GMV side. So if you want a safe answer, focus on net revenues, but it's sometimes a little bit more complicated. So looking at the dynamic and the power dynamics in between the different competitors that you have in the market, be they non-digital or digital, is actually an important thing to do. And to answer the first part of your question, yeah, we do prep our companies for Series A lot. We do believe that it's our job to set the targets together, to speak to the right investors, and to make sure that these processes don't take forever. And the best way to do that is to prep.
We can add some flavor from not marketplace startups as well, that I think our KPIs has changed like significantly over last 2 years effectively, because like trying to figure out what's the kind of meaningful KPI for yourself. Because like at the beginning, you can look into the user numbers and understand this is all random. Maybe it doesn't translate into revenue. Then you try to figure out who are like actual active users and so on and so on. And like in the end, you will find that one key element what actually makes sense for your business. And maybe these are not like the big, attractive and whatever numbers, but like these are the things that you need to focus on and like grow from there. And like I would say that investors like understand that. For investors, it's also important that you're not focusing on the vanity stuff, but more about the stuff what really matters. So for us, for example, is that can we see that our customers' accounts are growing? Is like significantly important. So we can acquire lots of customers, but we spend a lot of money on acquiring them, and in the end, it doesn't really matter. But if we acquire customers, they don't leave, and their accounts are doubling in every 3 to 6 months, then it kind of shows that the product is there, and it like you can do something with that. So coming back into this kind of really grounded views, what like makes sense, and instead of like this big like I have 1 million customers, what might not mean anything.
Mm. Super interesting. And we've got a question from Jason Drucker that I think is probably really good to ask you, Martin, having done your raise. What do you think the role of fundraise advisors or corporate finance houses with the Series A? Are they necessary? And I'm presuming this question, you know, has a different angle on it, considering the downturn when you know, founders are looking to save cash where they can.
I hope you are, Jason, are not from the finance house who is offering that service, but like I don't think so. So I do think like the best way to get good advice and good strategies, go and find people who have done it before and who have done it multiple times, or like just collect information from VCs and startup founders who have gone through this journey, because there's a lot of nuance where what you kind of experience when you're actually doing that. And there's like some things where on the paper can sound good, but like in practice might hurt you later on, like round size or like various different clauses in there, or like how do you sometimes it's better just to like raise smaller, even these kind of weird situations. Even if you get more money, it's sometimes better to raise smaller. And again, often these things kind of manifest when you're actually going through. And like I think there's this Plural Ventures VC fund who is kind of said that all the people who are there are like scarred people, means that they have got hurt doing stuff. So these kind of scars often kind of guide you in the right way. So this is what we did. Every single time we went fundraising, we raised there's like 2 groups of people who have money and the people who have knowledge, like simplified. But that means that we went to find people who have done fundraising, people who have crashed their startups, the people who have done marketing and all these kind of things. And they are now buying into the ticket into this company, means that they are vested interest of making sure that we are doing right things. Obviously, not all the answers and all the feedback is good from there, but at least they have an understanding how to navigate in this kind of environment. Because it's really difficult. Like if you think about like how do you operate, you are a startup founder, you're raising maybe your second round or something like that. But next to you is Louis, who does that every single day, sees like thousands of startups and knows everything about it. So having a kind of ramp up skills and getting all your friends' feedback and everything in is like really good actually. So I would suggest talking to the smart people instead of financial advisors.
Really useful. And yeah, I was actually about to ask Christina, but she's gone, about sort of where the angel advice comes in there as well, because, you know, a lot of the business angels have been through the process themselves, but I can ask her when she's back.
I can answer this from my point of view. Yes. Angels are really good. Like just in a short answer, like often angels have built their own startups. They are categorized people who have like less money, but they're really good advice and like understanding what's happening on the market. Especially people who have built startups in 2008 and these kind of times. That they know that dark times will go away and then good times happen, and then good times go away and dark times happen. So this is normal.
Yeah, really useful. Louis, big question about valuations here. Like that was so important when I started reporting on tech. You know, it was all about the valuation. And now, surprise, surprise, the little internal rounds, etc., not being quite so loud about valuations. They were never that as relevant at sort of Series A, never really announced at Series A compared to later on. But what are you seeing now? Are you seeing sort of valuation downgrades at this stage, and everyone's just being quiet about it? Is that just pretty standard by now?
I guess there are two questions, which is what's the right valuation to expect, and then valuation downgrades, meaning raising a down round, correct?
Yeah, let's shoot them both.
Okay, so on the first question, raising at a lower valuation, it's most likely going to happen. But before I answer question two, this is most likely healthy, because raising at a lower valuation also will avoid getting into problem number two, which is raising a down round. And raising a down round also means creating some level of friction with people that paid a higher price at the previous round. So the answer to the question one, will the Series A most likely happen at a lower valuation? Yes. Is it healthy? Probably yes. Are the valuations too low? I wouldn't say so. Like, again, if we go back to the stats that I was showing at the beginning of the webinar, like if a Series A is a 10 million round at like, roughly 40 million pre, 50 million post, diluting 20 or 25%, I think it's actually a fair round. And I've worked with a lot of startups that raised before 2018, and they're glad to have raised that money, pushed them quite far ahead, and they then raised large Series B at significant step up in valuations. So I would not be too scared about the valuations at which the Series A will happen. I think what matters is to be able to raise that money, be ready, raise that money, and then the valuation will be fair. I'm not too afraid of that. When it comes to down rounds, I can actually show like Carta had data as well on that I saw, and I think it's happening more and more. And it will likely happen more and more. So if you look at that again, you see that like down rounds used to be roughly 10 during the crazy times, like only 5% of the rounds that were happening, and now it went up to 20%. I think you've seen a lot of great companies raise down rounds, not necessarily at the Series A. I think Ramp, which was one of the hottest companies in the US doing spend management, just raised a round, which is a 20% down round, and it's a great use for the company. It's like 300 million more. So we should not necessarily see down rounds as like reflective of a company in a bad spot, but much more reflective of the fact that the market has gone down, and you can keep growing at a significant growth rate, and the fact that you can manage to raise money is actually a good signal. So is this happening? Yes. Is this going to happen more and more? Yes, as well, because we're about to see the cohorts of 2020, 2021, maybe early 2022 go out to raise money. And they're all there with valuations that are very steep. So they will either need to perform very, very well in order to justify these valuations or raise at an up round, or they will need to have these conversations when it comes to what's the right valuation for the company now. And again, I think it's a good discussion to have, and the existing investors as well as the upcoming ones and the founders can have a productive discussion around what's the actual valuation of the company. And it's not necessarily a very complicated one if everyone around the table is just aligned on the fact that the only thing that matters is to do what's right for the company.
Mm-hmm.
And actually, it wasn't probably right to rate at such a steep valuations at the previous rounds, because we're just creating the problem that's coming right now.
Yeah, you can always go up, but it's harder to go down. Yeah, James had a little bit more of a specific angle on that question, which was for Series A, companies that are raising a Series A and have like about €1 million ARR. What would be the typical valuation right now? But I am sure that the answer is it depends on the company. But what do you say to that?
I will try to give you a very precise answer to a question that can have a lot of different answers. But let's say if you qualify to raise a Series A, you will most likely raise a 10 million round, diluting 20 to 25%. So that gives you the valuation ballpark that you can have. And then, you have companies with like repeat founders in hot spaces growing super fast, and then you push the valuation up. And then you can go in markets where that are maybe less obvious to understand, with first-time founders in maybe the main geos, in which the valuations might actually be lower. But that gives you, let's say, the median round to say you raise 10 million at like 40 to 50%.
Got it. Christina, you're back.
Sorry. Yeah, I think they're doing Wi-Fi internet works around here just at the right moment. So I'm on my my cell phone at the moment.
Yeah, we've had like a couple of topics come up that would be great to ask you about. There's actually a question that's popped up in Q&A that I think would be good to ask you, from Sandy Porter. She says, is there if you're potentially going to be profitable in 12 to 18 months and you're now raising a seed round, should you be tapping angels or early stage VCs? I mean, we often see a combination, but I don't know, has that changed at all in the current environment? Is potentially what Sandy means.
So meaning right now, if she's fundraising now and expecting to fundraise to be profitable in 12 to 18 months, then yes, I would say it's always great to tap angels, typically because we have we like to really put in a lot of effort and share our expertise, our network, and I think that is a resource that just has a lot of empathy for the founder, a lot of experience, and they can also provide a lot of introductions. So, what I see as my role as an angel investor is to be a bit of obviously a thought partner from an operational standpoint. I typically like to invest in areas where I have experience myself or a really specific sector knowledge. So being a thought partner to the founder, being a sort of emotional partner as well, having been through the ups and downs of being an entrepreneur, and then also tapping my network of investors that have invested in me in the past, or that I do co-investments with, or as I see as a sort of pipeline for future investments. So I generally try to build relationships with Series A plus VC investors that I think share a sort of similar philosophy and how they like to support their startups. So adding angels earlier on will set you up for a strong relay, typically with the future potential investors that you might have on your cap table. So look for angels that have either a strong passion for the industry that you're working to solve challenges for, or looking to transform. And also that need other investment in startups that are in your similar sector. Yeah, and then they will hopefully unlock a lot of positive extra benefits of being on your cap table.
Okay, really useful. Hopefully,
and something really clear, which is like, yes, if you're planning to be profitable in 12 to 18 months, that's great. And that's great for angels. And that's also great for VCs. What depends is like what you're planning to do after, because VCs have different return expectation than angels. Like angels can be fine with, you know, exits that are, let's say, in the tens of millions versus for the mass to work for venture funds means you need to have even higher ambitions, which is sometimes crazy, but which is kind of the rule of the game. And that means that the question is not necessarily profitability. It's like, what's the path that you want to be onto? Are you happy to take as much risk as possible to try to build the largest company as possible? And I think that should be the deciding factor in between angel and VCs, not necessarily profitability. You have a lot of great companies that kept on being profitable and became, you know, massive ones and raising VC money.
Maybe one more point. Not everybody needs to raise money. Like,
yes,
don't raise money if you don't want to accelerate and grow your business like crazy, because that's a totally different type of business. If you're going to be profitable and you want to grow this as like a normal business, do that. There's nothing wrong with that.
for sure.
Yeah, because once you have, there's sort of no going back. I guess my question around that was, in this environment, do founders have to make that decision earlier than they were having to before? Was it something that you could sort of begin your company and then work out before? Are you now having to really decide what kind of company you want to be right from the get-go?
Just in general, can you hear me?
Yeah, I can. If you're struggling, feel free to turn your video off if that's easier, but yeah.
Okay, for now I'll keep it on. I guess the one thing that I would say on like when is the right time to think about angel investor versus VC. I mean, typically what you would see is if the founder has enough capital on their own to strap for a amount of time, then that's that, and perhaps enough traction for an early stage VC, or definitely enough traction for an angel investor, which typically has a bit more of a risk appetite and is more willing to invest on vision alone. But you're also seeing, you know, because of the macroeconomic environment, it might be tougher for people to fall back upon a cash pile than before. And maybe they're deciding to start a business because they've been laid off. So that might necessitate that they have to go for outside capital earlier than before. I think that's where you might see the shift. But typically, I think most entrepreneurs try to do it themselves for a certain amount of time if they can. And then the angel would be the sort of next friends, family, and angels. I don't like to say fools, but friends, family, angels, and then early stage VC, and continuing on in the VC investing cycle is sort of the path that you might see. Yeah.
Got it. And I guess, yeah, I was going to ask a bit later on, but this sort of brings us nicely to that in terms of the kind of founders that we're seeing getting funding right now. Is there sort of, we were making vague, incredibly slow progress to sort of opening up avenues for funding for startup founders in Europe. And is the downturn sort of making us take a step backwards in that sense when we're talking about, you know, whether you can bootstrap or not yourself, whether you've been laid off versus, I don't know, potentially had another business before. I've certainly written about sort of serial founders getting, I mean, it's a constant trend, but particularly at the moment, a lot of VCs seem to be in the fintech space very much backing serial entrepreneurs. So yeah, at the early stages and preparing for Series E, what are you seeing there?
I can jump in before my internet goes down.
Yeah, go ahead.
There is, I think, in general, just a reversion to the mean and the normal sort of behaviors. And the normal behaviors are typically to invest in people within your network, whether or those that have a track record of success. So to your point around serial founders, whether or not, I think, Martin, when you had mentioned in our sort of pre-discussion that there's stats that actually sort of negate this belief, but that serial founders have a higher likelihood of continuing on getting more successful with each failure. But there is this tendency, if a founder has done something well in the past, to expect them to replicate that again in the future. So there's that tendency to invest in those founders that have done it before. And then I think that's one thing that I will kick myself if I don't mention, founders, like women, female or gender diverse founders, founders of color, migrant founders. There's always been this sort of barrier to those types of profiles getting funding at the earlier stages. And there has been a tendency to bootstrap rather than get that angel check or a VC check. And then that one sort of prolongs that issue of accessing the right networks, whether they're other entrepreneurs who have done it before or VCs that can help support them financially. So without access to that network, it just makes it harder to be successful in building your business. And on top of that, when you're bootstrapping, it doesn't always allow you to have growth as quickly as you would like, or as quickly as it makes it easier for attracting external capital. So those are some headwinds. And now that there is this trend of either angels or some specialty funds focusing on gender diverse and ethnically diverse founders, investing in those specifically. Those still exist. Those still have capital to allocate. And then there still is this tendency, a reversion to the tendency to not invest in those types of founder profiles. So that's something that, 0.4% of founders are Black or brown, getting funded, 2% are women. So that's a trend that has to reverse. And unfortunately, this environment isn't making it any easier to address that challenge. So I would be remiss if I don't mention that.
Yeah. Really.
I agree with that. I guess the only thing to add is, like, as Martin said at the beginning, when the market is down, there's no better time to find opportunities. So there's probably also no better opportunities than to invest in first-time founders in weird geographies coming from, underrepresented minorities. And at Point 9, actually, the lion's share of the founders that we back are first-time founders, and historically, this has proved to be better investments. Because if everybody's chasing serial founders, it also means that you invest at a higher valuations. And in certain cases, repeat founders think that they know how to build a startup, and the reality is that every opportunity and every market is different. And to that extent, you always need to learn again. So that's one. And when it comes to, maybe geographies, we've invested in close to 30 different countries, and we're really convinced that great companies can come from anywhere. And sometimes we just invested in Athens. We have 2 portfolio companies in Armenia, one in Scotland, where there is very, very little VC funding. And usually, again, it's in places where you don't have a lot of people that you have the best opportunities.
And one question that's
question, Louis, is do you feel like that's more work or less work?
You mean from an investment standpoint?
Yeah. Because I think there's this, investors say it's more work, but I don't think it really is. So I'm curious if your successes around that, how you do that.
But I enjoy doing that work. It's actually a cool job to do.
Good answer. We had one question come in from Anthony Kens, who said, what about professionals in leadership teams who are sort of in their late 40s and 50s versus founders who are in their mid to late 30s? Is there any sort of opening up on that front?
Same topic. It's the topic of biases of investors. I'm a white male in their 30s, but I'm conscious of my biases. And I think a lot of investors are. I think there is. So in general, I guess the answer is it's probably not as easy, but at the same time, we also know that entrepreneurship is a game of outliers. I think Michael Bloomberg, when he started Bloomberg, was in his 40s, had failed 2 companies before, and it built this massive company. So I try to remove these biases of necessarily the best entrepreneur will be a white male from London, Paris, Berlin, or the US. I think it's wrong, or history has proven that it's wrong. So yes, there is a lot of hope for people coming at different ages.
Interesting times. I'm going to completely change the topic now to M&A, because this is another form of access to capital. And Martin, I wanted to ask you, as a founder on the ground in all the founder WhatsApp groups, etc., I imagine we all know that there's lots of conversations happening right now. do you think Series A is sort of going to be the hotspot of deals that we're going to see in the sort of next 6, 9, 12 months? What are you seeing?
There's a short answer and a long answer. And the short answer is probably yes. The long answer is I think it's less sexy than we all think of. And the problem with that is, I think a lot of these companies, what will be acquired, are suffering, and they will be acquired because they can't continue their business anymore. So it's not like that Facebook acquires Instagram because they're going to grow significantly, like so fast, and will threaten their business in the future potentially. It's more about like, hey, these companies go under, they want to acquire their IP or customers or whatnot. And this is happening already. I can see that happening in the last 6 months, like silently, the companies who raised too much money didn't find traction, and now try to figure out what to do, especially when you're in a kind of finance sector, like depending on the regulatory review, but like you need to wind down the business and then you need to find a place for your customers. So like every once in a while we'll get some offers that, hey, like, do you want to acquire this customer base or this customer base and so on. And now I think the big question there is that, yes, maybe you get it really, really cheaply, but like, do you really want that? You might get some customers, but like if they don't fit into your business, that might create like lots of complexity in a way that the customers operate in a different basis. They're not happy with your business. Your ratings go down. They ask different questions what you don't want to build. So the customer and the business are not linked. So I would say that like in the end of this year, there's a little bit of the graveyard of the businesses who are not able to do anything interesting, and they will be paddled into various different other companies. I saw 2 M&As last month, and they're like promoted a little bit like, hey, somebody got acquired us, and it's like a happy news, but like in the background it's less happy because not money will be made. Early stage investors lost actually money. Customers didn't get the better product. So it's more about survival than actual M&A. On the side note, it's a weird, I don't know, maybe 0.9 has kind of poked around as well, but we see really, really big VCs are kind of scratching the surface of successful companies and trying to figure out if they can do some kind of merger deals or facilitate some like the deals between the companies who are actually successful in these markets as well. So kind of try to kind of benefit out of that. So we'll see that happening, and like every once in a while somebody has a chat about that with us, but nothing concrete.
You mean in terms of merging competitors together?
Yeah. Consolidating like various different kind of places, like where maybe they have like investments or whatnot.
Yeah, I think, and we had this discussion this morning, actually, it's interesting, like if you are in an environment where there is a lot of money, a lot of competitors will have a lot of cash to invest in order to try to outcompete the other. And you saw that in the food delivery, in the ride sharing market, where like if you look at Uber and Lyft, now Uber has won the war, but it took close to 12 years for that to happen. And that was made possible by the fact that at some point ride sharing was so hot that like a lot of VCs were investing in that. It's going to be interesting to see what's happening in the scooter market, for example. Or it was interesting to see what happened in the quick commerce space. And in that case, yes, you have had a lot of M&A. Did a lot of people make a lot of money? I don't think so. So it's more like kind of crash types of M&A than necessarily, kind of aggressive one in order to win a specific market. At the end of the day, I think VCs can facilitate that, and it's also their responsibilities as board member, but they can't make that happen themselves. Like at the end of the day, it's about founders working together within 2 different entities, or working in one entity, or working together in a combined entity. And if founders do get along very well, I think these things are very hard to make happen. So M&A is first and foremost something driven by founders. I don't think we should create the expectation that VCs would do that. I think it's wrong.
Fully agree.
Interesting. I'm trying to get the goss and the deals coming down the road this side. We've got quite a few questions in the Q&A box about different sectors. In particular, Jeffrey's asking about deep tech, and we all know that AI has sort of proved a little bit of an exception to the wider trends that we've been seeing in investment. But I think Jeffrey's asking sort of, will this last? And, you know, given that there's this trend towards showing more financial metrics and really showing like the proof in your path to profitability, etc., when all of these ideas are quite nascent, do you expect that AI boom in this current environment to continue? I don't know who that could be. Maybe Louis, maybe Christina.
I can take it and
start from.
Yeah, go on, Matt.
Well, Martin.
So every single time, if you think about investing, there is one boom on the market. Today it's in AI. At one point it was like crypto. At one point it was like a last mile delivery. And this one sexy topic will raise ridiculous amount of money. The AI boom, like, while I think it's like super interesting and like a lot of value will be created through that, it will fade away in the same way as like every other boom in a way, and it's going to be yet another normal category, and there will be another booming category. So I would say that the AI boom, like the most useful thing for that today is that what people do is that a lot of brains go after this and try to build something really interesting. I literally invested into the AI company last week but not because of AI, mostly because still the kind of the basic pragmatic reasons, like the founder is amazing. I think the product, what they want to build is amazing. Like, will it be an AI or something else in the end? I have no idea, because again, it's pre-seed, seed round, like everything can change in the same time. So I would say that yes, today it's really sexy, but like it's not gonna last. Like it will change a different kind of category, but new stuff will come up as well.
Can I flip that question and ask if there are any subsectors that investors are shying away from right now at seed and Series A? This is Mark Fortum's question.
Probably for Louis.
Yeah, look, maybe the right way to ask this question is like, where are the majority of investors today? Because I think there are investors everywhere. You just need to find the right one. And it's true that like the majority of investors, let's be honest, they're in AI and they're in SaaS. They're a bit less in fintech, maybe, still in consumer, and they're less in deep tech. They're less in hardware, than less in biotech, etc., which are sectors that have proven a bit harder. And the reason why there are so many investors today is because a lot of investors have made money in the past, and people making money attract other people that want to make money, and you have kind of this snowballing effect of like a lot of people being at the same place. At the same time, if you try to do your job right, then I'm telling this consent of the fact that I'm primarily a software investor. You try to go where not a lot of people are, because the right way to kind of make money as an investor or do your job right is not to go where everybody is, because if everybody is there, like it means the opportunity is already recognized, and to that extent, it's already kind of priced efficiently in the market. That said, you can also explain some of the booms that are happening in the markets, market after markets, as Martin mentioned, by the fact that sometimes there are fundamental innovations where you think it's going to have a dramatic impact on, certain markets, and to that extent, you want to be part of them. And so, before the dot-com bubble, like Amazon was created before the dot-com bubble. So if you wanted to be in the, marketplace e-commerce leader, you had to invest when there was this, boom in the e-commerce space. You didn't need to wait for after that. And to that extent, you can actually argue that like some of us do invest in AI now, despite the fact that we're probably in somewhat of a, bubble when it comes to the amount of investment that's being invested here, because people share the belief that some of the fundamental pillars of what could be the next kind of innovation within the software ecosystem and in general are created now. And to that extent, it justifies investing today. And still, these companies are so early that if you think about the value that they can create, the valuations that you pay today remain fairly low.
Just one thing also to mention on deep tech, I think that there is a distinction between deep tech and general general AI, artificial intelligence companies. So deep tech, I always see as a very sort of frontier technology, working on large problems that have a longer term solution cycle. And typically those who are investing in deep tech, as Louis mentioned, there's fewer of them because there is typically a longer investment cycle and there's a lot more patient capital. And I think what we also have seen actually since COVID is that there's a lot of investors that are now thinking more, investing more with an impact orientation, whether that's from a social perspective or an environmental perspective. And I think those types of founders that are building those types of solutions also have a lot of successes with family offices, for instance. Those have a much longer term view. There's a lot less elasticity and parallel and a lot less ties to how the macroeconomic conditions are doing in the general fundraising environments. So I think that there is a difference between the current boom around generative AI and different types of large language, natural language processing. I see it as very different from deep tech. And the one thing I would say around that, if you are building a deep tech product and you're perhaps a spin out from university, think about also the amount of equity that you retain if and when you have a spin out from the tech transfer office. And I think the US is doing a really great job around building some standardizations around what those terms look like. In Europe and UK, we're sort of catching up a bit, but that's also, I think in the beginning, we had said we would talk a bit about, how much founders should retain at Series A and beyond. A lot of investors won't invest in companies that have too little equity in the hands of founders at Series A. So, and I think that those companies that are stemming from universities are the highest at risk, and also venture builders are the ones that are higher at risk of falling into that trap of not incentivizing the founders for the long term. But deep tech, I typically see as a very, 20-year investment cycle in general. So I have a little bit more leeway for the metrics I'm looking at for those types of companies.
Yeah, that's really interesting. Yeah, especially
to talk to that person, maybe one thing we can share is, like, I saw that on Twitter the other day, which I thought was good. Like, if you look, like, hardware is an overlooked venture opportunity. 50 to 80% of the most valuable companies in the world are hardware companies. Yet the ratio of investor startups in this category is the lowest, and Mona is a VC. So, like, people recognize the fact that you have big companies to be built, and big companies have been built in the past, and there are fewer investors, so probably the opportunity is better. So if this person is curious, you should probably look at this post. But good luck raising money. I think it's possible.
Brilliant, thank you. We've got 3 minutes, so this will have to be a very, very quick question. But we've had quite a few questions around sort of what else, other than showing your path to profitability and increased financials at these early stages, do you need? As Stephen Fry has asked, are investors looking for more impact at the moment in their investments? We've obviously seen climate tech doing quite well at the moment. Then also another person I can't quite find has asked about what about the leadership team, and is that really, really important when you're jumping from seed to Series A right now? So who would like to take that quickly?
I think on the impact side, again, we've made the point a couple of times, but just focus on the types of investors that, really have a strong belief in what you're building and a lot of experience and network in that sector. And those that are investing in impact-oriented startups, there's a lot more emphasis now on what are the metrics you're focusing on that really will prove that you're having some sort of impact, quote unquote impact on the area that you're working on, whether that's in climate or if it's in social. And I think that there's still a lack of clarity around what are the right tools, what are the right frameworks to actually measure, and how does that startup impact trickle down to the fund's impact back to their LPs who are investing in the funds. So if you're really thoughtful about the metrics that you can use to prove that you're actually having an impact, then that will always position you really well.
Great. Thanks so much for answering that in such a... I'm going to have to close us up before we get cut off. But we do have another Sifted Talks next Wednesday, which is actually talking about how to fund your climate tech business. In case you are interested more in the impact side of things, please join us for that. But thank you so much to our 3 speakers, and also to our audience. You've been super engaged, and I'm sorry that we've got so many questions in the Q&A box. So potentially maybe we can do another talk like this soon. But thanks so much to the panelists for answering all those fresh questions so well. And yeah, looking forward to the next Sifted Talks.